In this opportunity, we are going to continue talking about the adjustments that often are necessary to do to evaluation of a project or a firm. In a previous video, we discussed the adjustments regarding the discount rate. In this presentation, we will refer to the adjustments related to the present value, that is, to the discounted cash flows. The adjustments regarding present value will be classified into 5 groups: liquidity, key persons, ownership, control premium, and real options. Let's start with the liquidity adjustment. This adjustment is very difficult to do because it depends on many factors and is very particular to every case that we are analyzing. The liquidity adjustment depends on the factors that we show in this table. First, size. The larger the firm, the smaller the illiquidity discount in general. Second, the investor. Some investors are keener on liquidity, others not so much. So depending on who is the investor, then the desire to apply a liquidity discount will be larger or smaller. Time. Desire for liquidity changes over time. For instance, in times of economic uncertainty, the illiquidity discount tends to be higher than in times of economic good times. Potential buyers. If we are dealing with a company that has a very large number of potential investors who are interested in buying shares, then of course the illiquidity discount will be smaller. Asset liquidity. If the company we are analyzing has some assets which are very liquid or are very easy to liquidate, like for instance securities or real estate assets which are attractive assets. So in general, the liquidation value of these assets will represent the minimum possible value of the company and will determine a maximum possible liquidity discount. Financial distress. A distressed firm is more difficult to sell. Going public. If the firm we are analyzing is going to be traded soon in the stock exchange, it's going to become a public company soon in the near future, of course the liquidity discount will be less relevant and less important. And control. If a controlling block of the company's stock is for sale, then of course the liquidity discount will be lower because it is assumed that the people who are buying the control of the company will not be liquidating the stock in a near future. There is some empirical evidence as to the amount of this illiquidity discount. And this analysis has been done by comparing the prices of shares which are negotiable with other shares which are not negotiable in the stock market. So it is quite common to have some companies whose shares are traded in the stock market and other shares of the same company are not. If we look at the difference in prices between these two types of shares, we can have an idea of how large is the liquidity discount. And it has been found that the illiquidity discount is in the order of 30 to 35% in average. So we can think that an illiquidity discount of between 20 and 30% seems like a very reasonable one, at least 20%. One issue which is important about liquidity is that liquidity is not stable. In times of big falls in stock prices in the market, illiquidity becomes higher and the illiquidity discount should be also higher. So when we apply a liquidity discount to a long-term investment, actually what we are doing is that we are estimating an average liquidity discount. The other topic is the key persons discount. Some companies are dependent upon the owner or on a few people, a few key people. For instance, that was the case of Apple and Steve Jobs. The value of these companies is, of course, negatively affected if these people disappear or are no longer associated with the company. So when these people leave, the value of the stock will fall, and it is necessary to apply a discount. The problem is that the quantification of this discount is not an easy matter. Conceptually, the impact of this item must be evaluated by computing the difference between the value of the firm with and without the key people. So we find the value of the firm with the presence of the key people, the value of the firm without the presence of the key people, and of course the difference between these two values will represent the key person discount. Other important topic is ownership, and this refers mostly to emerging market companies. It has been found that when we have a company in an emerging market which has a substantial portion of its stock in the hands of foreign institutional investors, this is a good thing for the company. The price of the stock tends to be higher, as it is shown in this bar here. On the other hand, when we are dealing with a company in the hands of a family, okay, if the family ownership is a very, very high proportion of the stock, then that is translated into a fall in the value of the stock. However, when the family participation is moderate, in this case between 20 and 25%, we see that this has a positive impact in the value of the stock. So we can summarize by saying that investors typically assign a valuation discount to family firms without minority shareholding protection. So it is necessary to have another shareholder, like an institutional investor, present as a stockholder, so that the firm is worth more. In contrast, evaluation premium takes place when families wield significant but not absolute influence. Yeah, when families have a certain moderate percentage of the stock and still they have a participation in the management of the company, this is a good thing. This tends to be a good thing. This increases the price or the value of the stock because it is presumed that the family will impress a stronger focus on value creation. And finally, significant foreign institutional participation will mean evaluation premium, as we said before. Control premium. The majority shareholders in companies benefit from the firm's residual rights. And by this, we mean that majority shareholders are the ones who have the right to manage the company. So they have additional rights on top of the rights of a normal shareholder. For this reason, majority shareholders are worth more, majority shareholdings are worth more than minority ones. The difference in values between the majority shareholding and the minority one is known as the control premium. The value of the control premium depends on the value aggregated by the majority shareholder. So the more efficient is the majority shareholder in its administration of the company, of course, the more valuable the shares will be for this majority shareholder, and the bigger the difference will be between the value of the shares of the majority shareholder and the value of the shares of the minority shareholder. So the bigger will be the control premium. But what is important is to understand that the control premium depends in each instance on the characteristics of the majority shareholder. There is no general rule for the control premium. However, there is some evidence as the average control premium. This evidence comes from the United States market and is based on mergers and acquisitions. And we see that, in average, the control premium is in the order of between 30 and 40%. Real options. The net present value rule that we use to value companies and projects ignores real options. And by this, we mean the flexibility associated with most investment decisions. Whenever we do an investment, actually this is this usually is not an inflexible decision. So over time, we can modify the investment, the characteristics of the investment. For instance, we might defer the investment. We might wait to invest until a more favorable situation, or we might expand our project if the things are going very well, or we might liquidate the project before the final date because the situation is not as good as we expected. So this flexibility, of course, has some value. And the value of this flexibility is known as the value of the real options associated with the project. And the value of these real options, of course, should be added to the discounted cash flow. But in general, this is not done so. This is not done. So people really do not add this value of real options to the discounted cash flow. And the reason is because valuing these real options is a hard undertaking. There is a very simple way to do it, which is through decision trees. But these decision trees are not very accurate. They are very easy to criticize. And there are more complex procedures like Monte Carlo simulation or option pricing, which are much more complex and difficult to apply. The other topic that we want to cover here is double counting. Some of the effects that we have covered in the previous video and this one might be correlated among themselves. For instance, if we think of a firm whose shareholders are not well diversified, usually this firm's shares also will be relatively illiquid. And also probably the company will be in the hands of a family or the founding shareholders. So we see that if we apply different discounts or different adjustments to each one of these characteristics, probably we will end up overestimating the adjustment. So in general, we should be very cautious about this. Okay, whenever these adjustments overlap, they should not be simply added up. Okay, they should be more moderate. In conclusion, then, in this video, we complemented the previous one by explaining the valuation adjustments related to the present value of the company. And this included the liquidity adjustment, key person adjustment, ownership, control premium, and real options. And this is all I wanted to share with you in this opportunity. Thank you.